What is the stock market? How do you make money in it? What are some of the different ways that people invest their money into the stock market? How can you get started investing in the stock market today? Welcome back to the official Finflix channel. These are the questions we're going to answer in this video. So if you want to learn more about the stock market, lock in and stay tuned. Don't forget, if you like this kind of content and want to see more, drop us a like and subscribe. Without further ado, I'm here to teach you how to get good with money. Let's start off by answering the first question, which is, what is the stock market? The stock market is simply an exchange where people buy and sell pieces of ownership in companies. When you buy a share of stock, you're essentially buying a small piece of that company. For example, let's say you buy one share of Apple stock for $100. Now you own 1/100th of 1% of Apple. You don't actually own any physical part of Apple, but you do have a small claim on a tiny portion of the company. But why would you want to do something like that? Why would you want to buy a tiny portion of a company? Well, hopefully the company will grow over time and your piece of the pie will be worth more money. Or maybe the company will pay out a dividend to shareholders. A dividend is simply a distribution of a company's profit. It's usually paid out in cash or additional shares of the company's stock. But there are other types of investments besides just stocks. The next question is, how does the stock market actually work? Well, the stock market is facilitated by exchanges such as the New York Stock Exchange or the NASDAQ. Exchanges are simply organizations that bring together buyers and sellers of securities. Securities are simply a general term for financial assets that can be traded. This includes stocks, bonds, options, futures, and other types of investments. On these exchanges, buyers and sellers can come together and transact business. If you want to buy a stock, you place an order with your broker, who then places that order on the exchange. If there's a seller on the other side of the market who wants to sell at the same price as you are willing to purchase, then the trade will go through and you'll purchase your stock. However, it's not that simple in reality. There's way more that goes on behind the scenes. We'll talk about that in another video. Now that we know what the stock market is and how it works, let's take a look at some of the different ways that people invest their money. The first type of investment we'll discuss is called an index fund. An index fund is a type of mutual fund that seeks to replicate the performance of a particular market index. A market index is simply a benchmark that tracks the performance of a group of securities. For example, the S&P 500 is an index that tracks the performance of the 500 largest companies in the United States. So an S&P 500 index fund will simply hold all of those 500 stocks in the same proportion as they are in the index. This means that an S&P 500 index fund will behave almost identically to the S&P 500 itself. Index funds are popular among investors because they offer a low-cost, diversified way to invest in the stock market. They're also a great option for beginner investors because they don't require a lot of maintenance. Once you invest your money into an index fund, you can basically set it and forget it. This means you won't have to worry about picking individual stocks or trying to time the market. You simply invest your money and then you let the market do its thing. The next type of investment we'll discuss is called an ETF, or an exchange-traded fund. ETFs are similar to index funds in that they're a type of investment that holds a bunch of different securities in one package. However, ETFs are traded on the stock market like a single security. This means you can buy and sell ETFs throughout the day, as long as the stock market is open. ETFs are also known as a type of passive investment, which means they don't require a lot of management. Just like index funds, ETFs are a great option for beginner investors because they offer diversification and low costs. They're also very flexible since they can be traded throughout the day on the stock market. The next type of investment we'll discuss is a mutual fund. A mutual fund is a type of investment that pools money from multiple investors to invest in a wide range of securities. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds can invest in a variety of different types of securities, including stocks, bonds, and other types of investments. Some mutual funds may focus on a particular sector of the economy, such as technology or healthcare, while others may focus on a particular investment strategy, such as growth or value investing. Mutual funds can be a good option for investors who don't have the time or expertise to manage their own portfolio of investments. However, It's important to note that mutual funds typically have higher fees than other types of investments, such as index funds and ETFs. This is because mutual funds are actively managed by professional fund managers. So if you're looking for a low-cost, hands-off way to invest in the stock market, a mutual fund may be a good option for you. Just be sure to compare the fees of different mutual funds and historical performance before investing for best possible results. Next, let's talk about the next type of investment, which is a bond. A bond is a type of debt instrument that represents a loan that you make to an entity such as a government or a corporation. When you buy a bond, you're essentially lending money to that entity in exchange for regular interest payments. At the end of the loan period, the entity will return the principal balance to you. Bonds can be a good option for investors who are looking for a fixed income stream or who are looking to diversify their portfolio away from stocks. However, it's important to note that bonds typically have lower returns than stocks. This is because they're considered to be a less risky investment. If you're looking for a safe, low-return investment, then bonds may be a good option for you. The next type of investment we'll discuss is real estate. Real estate can be a great investment for those looking to build wealth over time. Owning property can provide rental income and appreciation. Rental income is the money you receive from tenants who rent your property. Appreciation is the increase in value of your property over time. Both of these factors can contribute to the growth of your net worth. However, it's important to note that real estate can be a very hands-on investment. If you choose to invest in real estate, you'll be responsible for finding tenants, collecting rent, and making repairs. If you're not prepared to take on that responsibility, then real estate may not be the best option for you. In that case, you may want to consider investing in a REIT. A REIT is a type of investment fund that invests in real estate. This can be a good option for investors who want to get exposure to the real estate market without having to actually manage any properties. Alright, now that we know the different types of investments available, let's take a look at what a stock is. Stock is simply a share of ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. You can think of it like buying a slice of pizza. If you buy the whole pizza, you own 100% of it. If you buy half the pizza, you own 50% of it. And if you buy one slice, you own 1/10 of 1%. The same concept applies to stocks. If you buy one share of a company, you own a tiny portion of that company. Stocks can be a great investment for those looking to build wealth over time. The value of a stock will fluctuate based on a variety of factors, including the company's earnings, the overall health of the economy, and investor sentiment. Over time, the value of a stock should reflect the company's underlying value. This means that stocks have the potential to generate high returns over time. However, it's important to note that stocks are also a very volatile investment. This means that the value of a stock can fluctuate wildly in a short period of time. For example, let's say you buy a stock for $100. The value of that stock could increase to $120 over time. But in the short term, the value of that stock could also decrease to $80. This volatility can make stocks a risky investment for some people. If you're looking for a safe, low-risk investment, then stocks may not be the best option for you. But if you're looking for a high-return investment, then stocks may be a good choice. Alright, now that we know what a stock is, let's take a look at another type of investment, which is called a retirement fund. Retirement funds are designed to help people save for their retirement. There are a few different types of retirement funds. The most common type is a 401k. A 401k is a type of retirement plan that's sponsored by an employer. Under a 401k plan, employees can contribute a portion of their paycheck to the plan. That money is then invested in a variety of different securities. Employees can choose how their money is invested, or they can choose to have their money invested in a target fund. A target fund is a type of mutual fund that automatically adjusts its investment mix as the investor approaches retirement. 401ks are a great way for employees to save for retirement, because the money invested in a 401k is tax deductible. This means that you can reduce your taxable income by the amount you contribute to your 401k. This can result in significant tax savings over time. 401ks are also a good option for people who don't feel comfortable managing their own retirement fund. That's because the money invested in a 401k is typically held in a target fund. As mentioned earlier, a target fund is a type of mutual fund that automatically adjusts its investment mix as the investor approaches retirement. Target funds are generally well-balanced and diversified, which makes them a good option for most people. Another type of retirement fund is an IRA. An IRA is an individual retirement account. IRAs are similar to 401ks in that the money invested in an IRA is tax-deductible. However, unlike a 401k, an IRA is not sponsored by an employer. This means that you'll have to find your own retirement plan. If you're looking for a retirement fund, a 401k or an IRA may be a good option for you. Alright, so now that we know what some of the different types of investments are and how the stock market works, let's finish off by talking about how the wealthy use the stock market. The wealthy use the stock market in a variety of ways to grow their wealth. One way is through dividend investing. Dividend investing is a strategy that involves buying stocks that pay a dividend and then reinvesting those dividends back into the stock market. This allows investors to earn income from their investments, while also growing their portfolio. Another way the wealthy use the stock market to grow their wealth is through investing in index funds. Index funds are a type of mutual fund that tracks a particular market index. By investing in index funds, investors can easily diversify their portfolio and take advantage of the long-term growth of the stock market. Additionally, the wealthy often use the stock market to hedge against inflation. Inflation is the rate at which prices for goods and services increase over time. When inflation is high, the purchasing power of money decreases. To hedge against inflation, the wealthy will invest in assets that tend to increase in value during inflationary periods, such as stocks, real estate, and commodities. Finally, the wealthy use the stock market to take advantage of market volatility. Volatility is the degree of fluctuation in the price of a security. When the stock market is volatile, prices can fluctuate rapidly, creating opportunities for savvy investors to make big profits. The wealthy often have the knowledge and experience necessary to navigate volatile markets and come out ahead. Alright, that's all I have for you in this video. Thank you guys so much for watching the official Finflix channel. If you liked this video, you will probably like the video on screen. Give it a watch. If you learned something new, please leave a comment down below. And if you haven't already, please like this video, subscribe to the channel, and hit the notification bell so you don't miss any new content. I have lots of other videos coming up where I'll teach you how to get good with money. Alright, until next time, I'll see you guys later.